Hello and welcome to Big Deal. As this financial year comes to an end, it's a perfect time to take stock of how the deal street fared and what is the outlook for the new fiscal. Joining me are Prashant Mehra, the partner at Grant Thornton Bharat, and Gaurav Sood, the managing director and head of equity capital markets at Avendus Capital. Gentlemen, so good to have you on CNBC-TV18. Now, Prashant, starting with you, give me an overview of how the M&A really panned out and overall deal street in the last fiscal gone by.
Anisha, thank you for having me. I think the year's been interesting. FY24, as we call it, which is the Indian financial year, we saw about $80 billion of deals passing through. While this is substantially lower than what we saw last year, which was about $130 billion or so, and the year before that about 110. Interestingly, the deal volumes have remained almost the same as last year, 1,700 this year as opposed to about 1,800 in the previous year. But the mix is something which has undergone a tremendous change. We've seen a very low both volume and value of domestic transactions. Private equity transactions have really maintained the same same volume, but the value has been lower. Inbound transactions is something that we've seen a huge surge, both in terms of value as well as volume. 60 deals to about 80 deals in this year, 20 billion to moving to about $85 billion. As far as outbound is concerned, that's been also subdued. I think there are 2-3 interesting things that we're seeing here. One, there is a heavy concentration as far as the Indian market is concerned. And also the India brand seems to be doing well in terms of the global transaction scenario, which is why a lot of inbound is happening. Outbound, not so much. Private equity continues to believe in the India story, but at the same time, there's been a value correction. As far as domestic M&A is concerned, yes, value both have come down, which again seems to be that the markets have been choppy. The geopolitics has been playing over this, and there's been some major valuation corrections as well. And probably something to do with the budget as well, which is just round the corner. So that's really been how transaction has fared during the last financial year.
Right. So Prashant, you highlighted many factors. And of course, going forward ahead of the elections, the deal street is in a bit of a status quo. But the big highlight for me for FY24 has been the capital market transactions. And that's also one of the big reasons why other deals, and especially private equity deals and investments, didn't take place, because of the equity market valuation as well as the large number of block deals of close to about $25 billion. Gaurav, jump in on this. And what's your analysis from the capital market transaction of the last fiscal?
Sure. Thanks, Nisha, for having me here from Avendus. I think clearly FY24 was a very different year in terms of capital markets versus some of the last few years. As you rightly said, I think it was the year of block deals. And obviously, I think one thing clearly emerged is that India was becoming more and more acceptable for global investors, both from investment perspective. So we saw large global investors come and participate in some of these block deals, but also from a private equity perspective. Clearly, in the past, one of the clear exit mechanism used to be secondary sales or private transactions, but blocks became the preferred mode of exits for a lot of these private equity funds, where overnight they could look to sell anywhere between 20, 25, 30% in a reasonably large company from a market cap of 20,000 crores to somewhere about 50, 60,000 crores. So billion-dollar blocks got done overnight, and overall, as you said, 25 billion worth of blocks got done. So clearly, India is becoming more and more liquid, mature, stable. Today, people are ready to accept companies with 100% float, no real promoter, with a strong management and CEO driving the company. So clearly, the year of block deals, and obviously, we expect this trend to continue, as we have seen even in this quarter. Large blocks have got done, and some of these large global MNCs have sold stakes in Indian subsidiaries, as well as large private equity blocks we saw. So clearly, this trend is here to stay as India becomes more and more liquid and robust.
That's right, Gaurav. So that's a big highlight of last fiscal, and you're saying that that's going to be carried forward for the next fiscal as well. Of course, a lot has to do with the equity market and also the valuations of the equity market, and especially with elections going, a lot really depends on this big event is what I gather. But Prashant, tell me one thing. It had an impact on M&A in the last year. Do you think that as more and more investors realize that you don't need to wait for a strategic deal and can exit through blocks, do you think that more imagination, innovation, and talks for strategic deals will eventually come down? Is that the trend that we are seeing?
Nisha, if I know the transaction market well, I think as far as exit is concerned, they'll always be very creative. And that's something that is required as well. So no, I don't think so. The creativity as far as exits is concerned, which is something that will go down. If you look at the stats, IPO market, yes, but IPO, QIP together, $160 billion has been transacted during the year, which from a last year perspective is double on what it was, both from a deal value and volume perspective. But I think, the value, $160 billion is a lot of money as compared to last year. And the year before that, of course, was post-pandemic. So it was 2 years combined into 1 year. But just last year has been phenomenal in terms of exits. The reason why domestic M&A has been down is perhaps because the cost of business went up drastically because debt became more expensive. And the focus was really not on acquisitions, but on making sure that there is good growth and hopefully leading to an IPO story, which would give them an exit sometime. So I think besides everything else, FY25, that IPO QIP story should continue.
All right. So Prashant, you made some very interesting point, and you also highlighted another economic macro factor which impacted the deal street, which is the interest rate. Now, we are all waiting for that event also. So for this year, apart from elections, turn in the interest rate cycle is another very big aspect. How do you see that really impacting? And especially after a very long pause, the capex plans, especially from the big, large conglomerates, has really made a comeback. So how are you seeing the way forward? And do you think that that also means some of this growth opportunities will trickle into larger acquisitions and consolidation by the bigger players? I'm mixing up a lot of factors coming together for the deal street view.
Whenever, there are some sudden changes, and that happened between the previous financial year and the current financial year, there is always a momentum that you see that, dies down and then it comes back again. I think the interest rates have been stable for the last quarter or two. I don't expect really interest rates to go up going forward, but stay stable or go down a bit. And I think that would fuel a lot of investment going into infrastructure. I think two more areas of capital is something that we should not ignore. One is the foreign capital coming into India. I think India's macroeconomics, the brand position, the India story, rather I would say the Bharat story, everything seems to be there. There's a lot of interest coming into India, and I think that will only increase. And the third bit is that what I consider the alternate source of capital, which is the private equities, they will soon start funding companies as well, especially the non-listed mid-market companies, in terms of both the strategic acquisitions, consolidation in the market, and fueling further growth. So I think the combination of these three things should see a lot of investment coming in, whether it's debt or equity.
All right. Very well summarized on that part. But I would say that the conglomerates and the animal spirit in the top corporates, that has seen a major shift. And that could be something that could take the deal street forward as well, because in terms of might, money, power, deep pockets, they stand the best chance. Now, Gaurav, talking about the IPO market, of course, this particular year, fiscal year, has seen small ticket sizes in terms of IPO compared to the last year, and also many but smaller. So volume play was higher. But I would say that some of the highlights for me in the last couple of years has been that the conglomerates, again, have scaled up their business. And after a couple of decades, many of them have come with new offerings and new listings. Let's talk about the types of Tata Tech, JSW and Birla Group a couple of years back and Piramal a couple of years back. So this is becoming like a trend. What do you have to talk about this and the way forward when it comes to the conglomerate action on IPO Street?
Yeah. So Nisha, clearly, I think within the conglomerates, there are obviously various businesses which these companies or these conglomerates have incubated for last 8, 10, 15 years. And with the strong appetite in capital markets, with the strong brand name franchise which some of these businesses represent, it was good time for them to look at public markets, because as public markets need large stable businesses, the fact that some of these businesses come from large brands, very well established, already having listed companies in the capital market, having delivered shareholder return over the last decade or even more than that. I think it was great time for some of these conglomerates to start thinking. There are 4 or 5 examples you already mentioned, but I think there will be many more IPOs that will come in FY25, 26 from these conglomerates across sectors, whether these are traditional sectors in financial services, infrastructure, or even some of these more newer age businesses. You will see a mix of both old school businesses as well as newer age businesses to hit the market from a conglomerate perspective. It's good time for some of these conglomerates also to get value discovery, price discovery for some of these businesses where they have pumped in money as well, and there is no real private investor, or maybe in some cases there might be a private equity investor in some of these businesses.
All right.
So it's good. I mean, it's a good mix of these IPOs that will hit the market in the next couple of years.
That's right. Couple of years, a lot of very big companies could be really rolled out from the conglomerates and large business houses. And we have to see those that could really change the way the dynamics of the equity markets work and create new heavyweights in the market as well. All right, hold on to your thoughts. We'll come back and discuss more about the Deal Street outlook for FY25 right here on Big Deal. Welcome back. You're watching Big Deal and we are discussing the Deal Street outlook for FY25. Now, Gaurav, we were discussing the IPO market. Big companies aside, there are large companies, unicorns in the startup space as well. Well, we have had many learnings in the last few cycles of the IPOs in terms of valuation, appetite, and the future after listing. How do you see the pipeline building for the new age and the startup IPOs and the valuation as well as the appetite picture? A couple of them, big ones, are almost ready to hit the market as I see.
Yes. So Nisha, clearly, I think obviously there is a case study with us from what happened in 21. And the good part is there are already 7, 8 companies from the new age businesses that are now trading significantly well. Most of them have created shareholder value. So, the private space understands that well, that what it now takes to go public, and versus 2021, where some of the businesses probably were not that well prepared. Today, businesses are simulating in a public environment 12 to 18 months prior to going public. So they are very well prepared, both in terms of processes, regulatory requirement, strong and sharp focus on profitability. And when we talk about profitability, it's not a fuzzy term there. We will be profitable sometime in future. People clearly have a path to profitability or already being profitable. So clearly, there is a large pipeline. We believe that about $50 to $75 billion of new market cap can get added to the current market cap in the next 2 years just from these new age companies. And the businesses are very, very different. They can be consumer tech businesses, fintech. Some of these businesses are from logistics, SaaS. So there is a whole host of unicorns from the private market looking to tap public markets in the next couple of years and very well prepared. So that's the best part. And the good part is today they have an option of doing one more round in the private side. So there is capital available both on the private side as well as public side, and it is their choice in 24 versus probably 23 when private markets were a little subdued. So today they have a choice. They can continue to stay slightly longer in the private market or look to go public. And as you said, a lot of them are reasonably well prepared, and some of them could hit the market soon, and especially in the second half of the year where we're expecting a lot of the billion-dollar IPOs.
All right. So a lot of billion-dollar IPOs. We saw very few of those last year. Gaurav, but the big highlight from what you said is the estimation of over $50 billion of market cap added with new IPOs in a couple of years in the Indian market. Now, Prashant, when we talk about the startup space, what do you see in terms of the fundraising activity now that is starting to show some bit of green shoot, maybe? And what about other deal scenarios and themes picking up?
I think the Indian market has matured a lot in terms of way startups are perceived, and for the better actually. A startup, earlier was just about having a revenue model. Now I think whenever there is somebody is called investor friendly, it has to have a business model. And when I say it has to have a business model, it means that it has to be gross margin positive. You can't be buying something at a higher price and selling something at a lower price. And I think that path to profitability needs to be there. And I think the other fundamental thing which investors are increasingly wanting to look at, that the startup should not be able to just grow in terms of scale, but also scope. Which typically means that yes, you need to grow in terms of volumes, but also you need to grow in terms of the offerings that are there, especially because most of these startups are new age tech companies, which I would say are quasi, consumer or quasi retail companies. Yes, if it's a typical B2B model, then maybe scale is just fine, but otherwise scale and scope both are important.
Right. So you spoke about this, but what are the areas in which you're seeing M&A activity really picking up, Prashant?
I think if it comes to startups, IT will continue to be the flavor of the year. And I treat IT as more as technology, and that's an enabler. There is technology, everything that we do now. But otherwise, the evergreen sectors, I think infra is something that we will see emerging for sure. The other sector where we should see a lot of investments coming in is the banking sector, the pharma sector. Retail's already started showing a lot of signs. But I think, the media and entertainment, besides that one deal, that could be a one-off, but we should see a lot of activity coming into media and entertainment. And I would say, entertainment tech is where we should see a lot of activity.
All right. So media and entertainment tech, these are the areas which are going to see a lot of creative, probably, deals coming up. But Gaurav, when we talk about the overall, space for OFS as well as, FPOs, FPOs have made a comeback. Give me a sense on the kind of instruments and also a view on what the foreign investors have been really asking, gauging, and what has been their view now on India. How have you seen that change come up?
Sure. So Nisha, specifically on FPO, it's a product that we see less of in the last 7-8 years. There have been selective FPOs, but what we are seeing is selectively, very, very case by case specific. There are some advantages an FPO will have. What's happened in the last 8-10 years is that listed companies have used QIP as a mechanism to raise capital from institutional investors. But obviously QIP has certain criteria with respect to pricing, and only it can be allocated to institutional investors. So an FPO gives you much more flexibility in terms of pricing. It's not really governed by any formula. So there is much more flexibility where the large investors are. Plus, it also opens up a larger pool of investors versus the QIP only to institutional, and FPO is allocated to institutional investors, retail and high net worth, very similarly to an IPO. So there's a larger pool of capital available for FPO as a product, but you will see it very, very selectively in unique situations. Generally, QIP, which is a shorter, time frame product, which sort of you can raise QIP money in 3 to 4 weeks. Generally, that's the preferred means. FPO will obviously have a larger, because there is a more regulatory. You have to file a document with SEBI, so it's a longer process. You will see it case by case, but obviously it has certain advantages as we are seeing in certain situations.
All right. And Prashant, what about the other types of ideas like REIT, InvIT listing? Do you see any new themes picking in the equity market as well?
At least for this, the financially, which is FY25, I believe there's a lot more that needs to be done on the basics. We may not see such creative things, which is also because of, the geopolitical environment that we are in today. I think the focus would be strictly on India. and whatever is possible within India. That would be my gut feel.
All right. And do you think that there are any challenges when it comes to M&A and Deal Street for the coming year?
I don't think so there are any challenges, but I think something that perhaps the banking sector should evolve is that has the time come for India to mature and also look at acquisition financing, which is today not a means available. I think banks should look at that. That would really help the debt markets. Funding acquisitions is something that would really be an evolution for the Indian transactions.
That will be a big breakthrough in the M&A space in India, because that has been a very, very big constraint for a very long time. Gaurav, your thoughts finally on the key themes, challenges, and how do you see the equity market transactions right after elections?
So I think the key theme we are seeing in FY25, very, very early signs, whatever we saw in the last quarter itself, is that there is a slight move more towards the large caps. We've already seen some transactions on the listed side, and even for IPOs, you will see larger cap companies attracting quality interest. So a lot of those billion-dollar IPOs will be of companies which are $7-8 billion at IPO. Some of them will be $10-15 billion. So that's one of the clear themes. We continue to believe that primary capital will drive a lot of these IPOs. So obviously, IPOs will be used for some of the private equity exits as well, but also primary capital, which is a reflection of how investors are seeing the economy in terms of growth and capex for the next couple of years. So primary raise will drive IPOs, large IPOs. And I also think that investors will, private equity investors, while they will look to sell some stakes in the IPO, they will continue to partner with the company over the next few years and get the company more mature and stable as they look to exit completely from some of these businesses. So it's a win-win situation for both. Incoming investors can participate in the growth journey of the company and take returns, while private equity investors can, over a period of time, exit. And blocks will continue to be the theme. That's just a reflection of how India is today as a fifth largest market cap company, very close to Hong Kong. Right. But as markets become closer to $5 trillion with average daily traded volume, more than 2% of this market cap, it basically means that large companies are here to exist and 100% free float companies are here to exist.
All right. So widening and expansion of the equity capital market with new offerings coming in as the market remains robust is one of the key themes. Thank you so much, Prashant, as well as Gaurav, for joining us with your initial outlook on the FY25 Deal Street view. And a lot of action is expected on both M&A side, private equity action, as well as the equity capital markets. So waiting for FY25 for all those to really show up. Thank you so much for joining us on Big Deal at the end of FY24. See you in the next financial year. Thanks so much.